Hello and welcome to Switzer Investing TV. I'm Peter Switzer. Thanks for joining us on a day when we're all expecting an interest rate cut tomorrow. I tell you what, if Michelle Bullock, the governor of the Reserve Bank, lets us down, the market won't like it. Coming up on the show, I'll be talking to June Bay-Liu, now of a new fund she manages called 10Cap. And I'll be asking her about interest rates and the company she likes right now. And then Paul Rickard of the Switzer report, I'll see what he thinks about the interest rate cut tomorrow and what stocks he's positioning his portfolios for as a consequence of that expectation. So without any further ado, let's cross to June Bay-Liu. Thanks for joining us, June Bay-Liu.
Thank you for having me, Peter.
All right, the market is readying itself for an expected interest rate cut. Are you expecting a cut? And when it does happen, if it does happen tomorrow, how do you think the market will respond?
The rate is coming. I think the market will definitely trend higher. I think it's at the moment, even though 90% of the economists expecting the rate to be cut, I still think the share market is somewhat bit skeptical. So when it does come through, we should see the market run a little bit on top of it.
Okay, so what stocks do you think are going to be pretty quick beneficiaries of an interest rate cut?
Yeah, I like to buy the retailers plus the property trust. I think they will do very well and very quickly. And within this space, though, you actually have a lot of opportunities. It's time to buy some of the underperforming retailers and underperforming property trust, the value end of those sectors. So within the underperforming retailer, I know JB Hi-Fi will do very well. It will still go up. But I think the opportunity lies in, perhaps it's time to look at the Premier, time to look at the likes of Maya, which will be very heavily leveraged towards a rate cut. Another name, should look at is a Seek. Job has been, new jobs has been pretty tough, and this will be a huge beneficiary when the rate cut comes through.
Yeah. So what you're saying is typical of the market, it buys in advance of the real benefits to these businesses, because the first interest rate cut might have hardly any impact on spending. It will improve confidence from all those people out there with mortgages. But if I've got a mortgage and I'm struggling, I'm not going to instantly go to Harvey Norman and start buying myself a sofa. I'll probably wait for the second or third cut before I do that.
That's right. So share market normally value a company based on its earning in 12-month time. So all we're doing is assessing what's going to happen in 12 months. So usually from the first start of the rate cut, it takes about 9 months, 6 to 9 months before you actually see it in the earnings or see it in the consumer. So in 12 months, things should be a whole lot better for a lot of those businesses.
All right. One interesting thing is that the banks were down today. Do you think the banks will be less popular with interest rate cuts?
Look, I do think so. Usually interest rate cut, it does mean impact their margins somewhat, making less money. And also one of the big thing is about the banks that are expensive. Our banks are trading on very expensive multiple. And today we're already seeing a couple of them sort of coming through. Bendigo and the Westpac talk through a bit of margin disappointment. And if the rate cut does come through, we do think it will be used as a funding source, not a collapse, but more of a funding source.
Yeah. I've got to ask this question because obviously you don't ignore the analyst. You'd be taking all the information in when you make a decision. But the attitude of the analyst towards CBA, I was looking at FN Arena, 6 out of 6 don't like the bank at its current price. I think Citigroup sees a 43% fall in the share price. You're laughing.
Yeah.
Yeah, but to me, I wouldn't be surprised over the next year if CBA traded down about 15% or something like that. And it has typically happened when market goes against it. Is that too outrageous for me to think that a 15% fall in the CBA share price is a possibility?
Yeah, look, I think it's possible just because how expensive it is. But you kind of do need, the market. If people see a lot of other opportunities, then potentially it'll be go down. And I think for really to get to that 15%, you do need a bit of wobble in the market as well. Just ultimately, look, the bank's numbers are not bad. You probably need people to worry a little bit about, the share market and everything else in a big index way, right, for it to sort of get there. But certainly not going to fall 40%. I think 15 is probably more reasonable to assume.
Yeah, that's what I've been doing with my clients. Anyway,
Mhm.
let's go to some interesting ones. Aristocrat Leisure. What do you think of that company?
I think it's a great company. I think it's doing incredibly well. And recently, all the data points are showing how strong it is. US consumer is doing really well, and then they are going to playing the slots. So, I actually think the company, despite share price gone up a lot, I think it's still a buy.
What about Cochlear? It's copped a bit. It's a great company. Is it a good buy at these levels?
Yeah, it's a good buy. I was surprised how far it fell. Cochlear is a company that is one of the rare high quality business in this market. Every now and then it has a hiccup in terms of timing. It's got a new product coming. Usually the existing old product sells a bit slower when the new product comes through. So, that's why it copped a bit of a sell off, but it always recovers. And this is your buying opportunity.
Okay, help me understand this. Insignia used to be IOOF,
Mm,
which didn't cover itself in glory, and
mm.
the Hayne Royal Commission and financial planners didn't get a very good rap out of that. Changed its name, and now it's done very well. Why is Insignia so well? It's off the boil a bit at the moment, but it had a big
Mhm.
rise. Why has it had a big rise?
Look, it's partly because at the moment there's a lot of M&A sort of interest here in Australia, right? Especially in the wealth businesses.
Mm.
Australia actually has one of the largest wealth sector, and then it's filled with a lot of older player where they haven't innovated. They've been going backwards. In Insignia is one of them, and with Aussie dollar where it is, we suddenly seeing all these opportunity like an interested party. So Bain Capital has put a bid for Insignia, and then we've got CC Capital also came out, put another bid, and now recently we heard that Brooksville is putting a bid as well. All of them at the same price at the moment, $3.60, and they all performing due diligence at the moment. So potentially price could be higher, but look, if there's anything that get uncovered in due diligence, it may not, something it may fall quite a bit. So we're still waiting to see what the next step might be. I think the Insignia just said that they want a final bid to buy in 2 weeks.
Yeah, okay. Now, today, a lot of companies that I like have had a nice day. Like Tyro is up 6.7%. Ordinate, which I've been
Mm.
always asking you about, only because I hold the share,
Mm.
and it's had a nice day. What's behind that one, Jimbo Lab?
Oh, look, it's all the share price has been depressed for so long, and it's heavily shorted. I think it's something like 30 days, many days level to cover, as in for the short seller to buy back their shares. So the higher the share price go, the more they are forced to buy back, and they can't wait till tomorrow because they measured every day. A lot of those hedge funds, so that's why you're just seeing everyone heading for the door, and so you've seen that significant rise in the share price, and the result came through a bit better than expected. They delivered a profit and the like. So, more or less in line with expectation, but really you've seen the short seller forcing the price to go up significantly higher. And what that also did is that has caused a lot of fear across every other stock that's been heavily shorted. So,
Yeah.
your Tyro, your Megaport, and even Zip sort of recently seeing a bit more short level. So I would say this reporting season is almost, you've seen quite a lot of, what do they call a short seller's graveyard.
Yeah, I think last time we spoke, you might have liked Block or the old Afterpay.
Mm-hmm.
Is Zip going to always benefit from any upwinds that help Afterpay or Block?
Yeah, so I do think so. I think the block is looking, it's going to report very soon. Obviously, there's been discussion what it looks like, but the share price really underperformed into this result. We think block looks quite cheap relative to other growth companies. Afterpay is doing very well there. Their cryptocurrency division is doing quite well. I think the company itself is doing quite well over there. So that looks quite interesting. Same as Zip. Clearly Zip has done very, very well in the last 12 months, but more recently it's underperformed because of the analysts, one of the analysts didn't quite forecast it properly. So I think results coming as well. Cynthia will talk through, all the great things they're doing. And then, it's growing, like it has very, very strong momentum.
Okay. I will finish off on lithium.
Mm.
For the person who wants to pick a sector that's out of favor, and I did notice that Chalice, which is not really in the lithium area, but it gets kind of tarred with the same kind of brush. Chalice has had a good day today. Is it? Do you think it's a sector worth investing on the basis that you might not get a great return inside a year, but maybe 2 or 3 years when everyone's driving electric vehicles, it's going to do well?
Yeah, look, it certainly looks really interesting. That's the thing I just asked my analysts more recently. And then you see the share price, not share price, the lithium price has moved a little bit because of the hurricane threats and the like. So, but the only challenge is it's a bit harder to call because even though demand slowed down, the supply, even at low prices, is just still not getting cut, to any significant extent. And they're still coming online. So that is the challenge for a commodity where, the demand slowing a little bit, but the supply is not getting cut, still coming, which means someone's still making money, which means for existing producer, we see it on our our listed market, those equities are it's still a little bit challenged. It's a bit harder to call at the moment.
Okay. And one final question. What have you added this week to your new fund called 10 Cap Capital?
To be honest, actually, what we added is Cochlear. We really like Cochlear.
Now, what are you enthusiastic about
Yeah. No, I think Cochlear is almost a no-brainer. It's a great buy. Another little one we bought is Maya. We just think it's it's fallen a lot because of the restructure and then purchasing of those brands. But I do think it's it has quite a lot of positive catalysts coming through, and it's not expensive as well. And it sits in that sort of consumer bucket, just looking pretty cheap.
Great stuff. Junbei Liu from 10 Cap. Thanks for joining us.
Thank you very much. Thank you.
And that was Junbei Liu of 10 Cap. Remember, that's a new fund. She used to be at Tribeca, and now she's at 10 Cap. Coming up is Paul Rickard of the Switzer Report, and I want to see what stocks he likes right now. Okay. Thanks for joining us, mate.
Thanks, Peter.
All right, so Paul, interest rate cut tomorrow. You weren't as certain a week ago. Have you changed? Are you running that small group of people?
I'm probably in the small group of people who don't think they should.
Why am I surprised?
But that said, they probably will.
Yeah.
So, I think if they didn't cut, market would sell off. If they do cut, a lot of this is already built in. So my guess is the market doesn't rally that hard, but you probably will see a lot more money going into smaller cap and some of the industrials and not the banks, the companies outside the top 20, I think, is where you'll see the flows tomorrow.
Yeah. It's funny you said it's built in, and Junbei Liu didn't think it was all that built in. But then I reflected on last week, we hit a whole lot of record highs. And I wrote the Switzer Report on Saturday morning. I said, well, I thought there must have been a bit of interest rate decision because the market was pretty strong on it. So it's going to be interesting to see. I guess the magnitude of the rise tomorrow will reflect how much has been built in. And I think what she said was that there are a lot of companies that people wouldn't have thought of, and they've gone for the most obvious ones, but there's probably going to be a lot of ones that we don't think about that could be liked tomorrow.
Yeah, my guess is that some of the bigger companies, we start to see a little bit of a pullback today in some of the bigger companies, slightly disappointment amongst with Westpac and with Bendigo. Interest rate cut has, the market, you said, Peter, has been at record highs. People have been afraid to sell it, and I think there's probably been a couple of reasons why they could have. And so I do think it is largely priced in, but I do think we'll get a rotation, as you've been talking about now for some time, into other companies, particularly some of the so-called, maybe some of the value companies that haven't done much, they've been left behind. I think people are now saying that some of these big companies look really pricey.
And
And,
they are.
you know, when CBA is trading on a price earnings multiple of 27 times,
Yeah.
more than a company like CSL, which is growing at 10%, and CBA is growing at 1%.
Mm.
You've got to start to ask, you know, how rational the market is. And, you know, there's certainly we're seeing some of the price actions today in companies that have reported a little bit better than expected. The market take off.
Yeah. Well, yeah, I got to say, I was writing my piece for the Switzer report today on CBA, and when I thought about it, like a term deposit for the next 12 months, it looks probably better than CBA because you're going to get probably what 4.5, 4.75% better than the dividend yield, and you won't get a capital loss. But CBA could easily, even Jimbo Liu, who likes CBA, said, you know, a 15% fall over the year is possible, and so therefore, in many ways, the market tomorrow could actually not rise because CBA and the big ones could be coming off the boil while the little ones are only making little gains.
Yeah, I mean, I think Westpac's result today, Bendigo's results.
Tell us about the Westpac result, Paul.
Well, look, it's a bit unclear because it's only a trading update, a quarterly trading update.
Yeah.
Westpac don't publish a cash profit anymore. They just look at total profit.
Okay.
But they did say that if you adjusted for a couple of items, revenue was up a little bit, but so were expenses, and their net interest margin was actually down a fraction.
Now, you always talk about the NIM.
And that's, I think, probably what the market doesn't want to see.
When the jaws are opening, that means that the NIM that's a good thing, isn't it?
It's a good thing when the jaws are opening. Otherwise, revenue is growing faster than expenses,
and
NIM was actually down a fraction. So maybe the market had put too much faith in Westpac.
Yeah.
New CEO on board, maybe. Perhaps a little bit of conservatism with a new CEO, you know what it's like.
Well, I remember you picking on the old one.
Look, I think probably the real one that I think they shocked many was the Bendigo one, which does, you know, we do get asked a lot of questions about regional banks. You know, when do you buy regional banks? Well, I didn't touch the regional banks when they're super cheap. And both Bendigo and Bank of Queensland have disappointed over the last couple of years.
Yeah.
Big time in the case of Bank of Queensland, and Bendigo's also come well off the boil, and it's not that much. It is actually struggling, and what I think you're seeing with the regional banks now is that they have to have. They've probably got away for many years without having to put a lot of capital on the table to invest. They've now got to get their systems up to speed because there's so much lag in the big banks, and that's part of the price they're paying. They've all got a big investment spend. So regional banks, look, I don't think there's anything really attractive there. Stick with the majors, but the majors are super expensive.
Well, that insurers, Paul, they copped Peter Dutton's after them. He's gunning for the insurers.
Yeah.
Well, like the IAG and Suncorp, are they buys at these levels, or would you be a little bit? I remember when the Prime Minister went after Woolworths and Coles. The share prices were affected, weren't they?
They were. Look, I'm a bit surprised. I'm not sure what he's going after them about. I mean,
the premiums are too high, Paul.
Yeah, but look, you got to bear in mind that insurance is not like any other industry. We've got three large insurance players in QBE, IAG, and Suncorp, right? And they dominate the market. There are lots of sub brands. They are most of the sub brands. They all get their reinsurance where they go to insure their big risk from Lloyd's in London, you know, which is a price they don't control. But three insurers is no different to any other market. We've got four major banks. We've got two brewery companies. We've got one airline. We've got two major retailers.
Four supermarkets.
Three TV or four TV stations. It's the same, right? Australia is a small marketplace. So I think he's targeting them a bit tough. They have had a couple of really good years on the back of some big losses.
Yeah,
you know,
really good years.
And, you know, this whole idea of flood insurance and insurers don't help you and they've had to change their mind. I'm not sure what he's going on about. I mean, they're literally because of, you know, climate change, council's putting a lot of regulations in. Some places are now uninsurable, right?
Well, in fact, the boss of the insurance council made the point that what state taxes slug on insurers is actually bigger than their profits. So you might have to go after the state governments as well.
Well, if you now in a zone that's marked as bushfire prone, and there are parts of Sydney and Melbourne where some of the outer suburbs, Yeah, the insurance is through the roof, but that's partly because if you want to rebuild, you've got to rebuild to a fireproof standard. And the which is not perhaps unreasonable, but the regulations around that are so expensive. You can't do a dual occupancy.
Yeah.
The whole world's changed. So I think it's a bit tough, but maybe they're an easy picking because in parts of regional Australia, insurers are pretty unpopular.
Yeah. Yeah, I think the fact that they're slow to pay out doesn't help the
They
popularity
probably
of insurers either.
and look, and that's all they care about. Insurers never want to pay out. So
Okay.
look, I think I'm not sure what's driven the Dutton plan on that.
Votes at the election,
Yeah.
so one thing. And I think, look, I do think the ACCC has probably been a bit soft on the insurers. They could be a little bit more aggressive in their analysis of what they're up to. Paul, what's the favourite stock? You've been talking about car recently. Have you come up with a
Look,
new idea?
I think there's a bit of value. I'm very interested to see how Telstra reports. I think Telstra looks super cheap,
Yeah,
but
I agree.
it has been going off the last couple of weeks, and I worry whether maybe
Someone knows
something. So that's watch
it
this
can
space.
happen in the market, can't
It
it?
can happen. Watch this space on Thursday. So it's just been there's been quite a big volume and it's been drifting down, but not for growth, but as an attractive yield play compared to the banks, I think Telstra's interesting.
Yeah.
I think for the Brave, ASX is starting to look interesting again.
Yeah, and they're starting to like it too.
It has had two big issues on its plate. The first one is going to get the CHESS replacement, which is the big clearing system that we all use when we buy and sell shares. There's spent a lot of money. The project failed. They've started again. The market spent a lot of money and is really angry with them. ASIC's angry with them.
Yeah.
So
I'm angry with them.
Everyone's got they've got to get that that project right and on board. And secondly, that they do face some challenges. I guess they have a monopoly position effectively in the market, but a lot of reasons why companies don't want to list anymore, and they've got to get the listings going again. Otherwise, the Australian market is in danger of becoming, almost a non-event. So, but I do think under the current CEO, they've a lot of work on their costs, a lot of work on capital discipline because they've wasted a lot of money in the past. They had some,
and there used to be a very good dividend payer, Paul.
They're still a very reliable dividend payer. It's a yield of about 3.25%. It's not big, but it pays out about 90% of its earnings as dividends. So it was a $90 stock. It's now sitting in the mid 60s. I think there's a bit of value in that, but I'm not sure what the catalyst is. That's one stock I like.
Car, ASX, what else?
Well, I thought the other one that reported, I'm just having a mental blank all right last week, was Treasury Wine Estates.
Oh, yeah, Treasury Wine Estates.
Market didn't like it initially. And Treasury Wine Estates been on our growth portfolio for a while, Pete. I think they are a company that will rise to the challenge. And the challenge is that currently there's a global decline in wine demand or demand for wine. And where that's affecting the most is the so-called commercial part of the market, that is the mass market for wine. And that's because young people just don't drink beverages like the way they used to.
They're into wellness.
They're into wellness and they don't drink cheap wine. And secondly, where demand is increasing is very much in the luxury part of the market. So the whole Treasury Wine Estate strategy is so-called as a premiumisation strategy. Yeah. That was behind really trying to up the ante with Penfolds and the purchase of Diageo in the United States. And so they're doing really well in both those businesses. And Penfolds is shooting some good stuff happening in China now with Penfolds. Yeah. But it still has this commercial division, which it hasn't been able to sell. And it's got to get that back in order or find a way to reduce less capital. So market initially sold off on the report last week, but it's bounced back a bit. I think around $11. There's value in Treasury Wine Estate.
And I think the broker Morgans gave it a thumbs up as well over the weekend. Okay, Paul, thanks for joining us. That's Paul Rickard of the Switzer Report. And that was Paul Rickard. Thanks for joining us. Don't forget, if you want to know more about Switzer, you can see Switzer Daily every day, switzer.com.au. And if you want to become a subscriber to the Switzer Report, just go to switzerreport.com.au. Thanks for joining us. See you next week.